we will get this show on the road. It is a pleasure to welcome you all to the farm here. I see an awful lot of familiar faces, quite a few new faces as well. So if you are new, we try to have a pretty open format. You're encouraged to disagree with the speakers, especially Rodney. I'm trying to help you out there. Somebody asked why you got put in the fertilizer building to smoke the fumes, and I got in here with the air conditioning. I don't know. Roy said to do it that way. So anyway, it is a pleasure to have you guys here. We're going to get right down to work. Quite a few format changes from last year, in that we're not going to go off-site for a dinner this year. We're going to have the dinner in this building. So between 5 and 6, we have to get out of this room so that we can set up the room for dinner. And we're all going to be transitioning over to the tool shed where we'll have hors d'oeuvres and cocktails, and then some walking tours for those that are interested. Mostly just kind of a networking kind of a chance in the tool shed. We have all the good tractors lined up. The non-green ones are on a different site. So it's just kind of funny how that worked out. I don't know who planned that. Anyway, but it's a joy to have you here. We're going to split into two groups. We've got the signs up with what's kind of going on everywhere. One group will stay in here with me, and we're going to talk about thinking about how to deal with adversity. And we're going to do some I get a request every year to spend a little bit of time explaining what the silly lines are on the charts and to explain somehow how we use the thought process to make decisions. So that's the stuff I'm going to focus on. It's much more economic and risk management oriented. Rodney's going to take the other group over into the fertilizer building, which is insulated. It's still pretty cool, and talk about soil health and cover crops and a lot of things like that. So he's the one that does all the research. I would say he and Stephen do almost all the research and keep our protocols in place so that when Nick and I show up and drive the combines, we don't mess them up. And that's kind of the way that works. So just a few introductions. Rodney, my cousin, is going to be speaking about soil health. And then Stephen Boyer is our farm manager trainee. We intend to send Stephen to run a satellite farm once one becomes available, which we're optimistic it will in the near future. And back at the toolkits, Nick is our Beck's dealer representative, applies all the anhydrous, drives the combine with me all the time. And beside Nick in the bright orange shirt is Roy, who's actually the one that rules the roost around here when Dad's not here. And Dad's sitting on the end of the table down there. So Dad's been retired for a long time, but still helps us out in a lot of ways. There aren't many thistles in the side ditches, and if Dad sees one, it's dead. It doesn't matter whose property it's on. So at this time, let's just split into our groups. If anyone wants to follow Rodney out and talk about soil health and cover crops and our decision-making protocols and our formulas for applying various inputs, just follow he and Stephen out to the fertilizer building out the back door back here. He has threatened to offer people silver coins to get better attendance at his session. Well, from my perspective, this has become some of the best days of the year. This is like the first day of corn planting for me, or the second, probably not the first, the second day of corn planting, and about the fourth day of corn harvest. You just get out in the field, you get to kind of do what you enjoy, and for us, having you guys all here is a lot of fun. It's a great chance to renew some old friendships, but also forces us to actually do our homework and try to do a better job managing our business, because we have to tell other people about what we're trying to do. So the first thing, I titled this presentation, Dealing with Adversity, and the first point that we all have to admit is so far in agriculture, there isn't any. And that's why I could never find a chart that I liked of land values that kind of kept it in perspective, because what do the universities always do? Well, you adjust it for inflation, which is really cool, but as anybody in 1986, did they pay off those farms with inflation? That's not the way the game works. So I went to and thanks to the Missouri contingent that's here, the best data on this is at the University of Missouri, of all places. Iowa land values And I just got the data out of their tables and made a chart, very simple Excel chart. But I thought also pretty striking. And I like to make the point that landowners are the brightest lights in every room. Just ask them. But when we think about this, this is what's happened to land values in Iowa. It's the same curve everywhere you go. Missouri land values start out lower. The percentage increase is basically identical all across central United States. And interestingly, guess what? It's the same chart in Brazil and Argentina. Don't let those guys tell you that they haven't had the same benefit. And that's in dollars. If you put it in pesos, theirs is much more vertical than this. And I guess one of the things I was going to try to point out here is there's an awful lot of stuff in that price, right? There's an ethanol mandate. What do you think corn would be worth with 4 billion less bushels used for ethanol? About $1.50, what it was 20 years ago. So there's an awful lot in this. And the thing that's interesting to me, one of the things we talk about, if you come here in the past, is we talk about some of our core values, and one of our core beliefs is the currency's going to zero. And, that's not rocket science, is it? No. I mean, it's already down from 1 to 6 cents if you listen to the government. If you go to shadow stacks, which I think is interesting, we started playing with the data back in the 1980s. If you calculate the value of the currency the way it was calculated in 1980, the currency is now worth 2 cents, not 6 cents. That's a 300% difference. Some would call that probably misrepresentation by our friends in government. But the point I'm making on that is holding paper promises is pretty ill-advised. And luckily for us, in the farming business, none of us hold paper promises. But who does hold the paper promises? This is the first point that I think we should be thinking about as we plan for the next 5 years and what it might hold. The paper promises are all held by the poor and the elderly. Let's just be honest. If you're on food stamps, you're poor. If you're on Social Security and you're living on it, you're poor by any standard, by any calculation. And you can play with those numbers all you want, but the bottom line is inflation doesn't hurt the rich. Those are the rich. Inflation's good for the rich. Inflation crucifies the poor. And I don't know how to fix that. I don't think it can be fixed. It's the same in every country in the world right now. Go to Europe, it's a lot worse than the United States. But it's important to note, I think, and just to understand that, and if you're going to have a system that works like that, where you underreport inflation, and you have tax laws set up, and technology comes along and makes it real easy for the rich to get really, really rich, you have a chart that looks like this, where the middle class is disappearing, and the top 0.1%, it's not 1%, the top 0.1% has about 25% of the wealth in the United States right now. If you go back and look historically, every time that number gets above 25 to 40%, the poor just say it's over. The rich lose it. They'll lose it again, even in the United States. So anyway, when we get to talking about adversity, the first thing I want to say is that I'm just going to present some facts, and I want to present some facts that the university guys should be telling you. Purdue just did their land webinar, and it was like steady as she goes. Land's going to go up or down a few percent. And that's all fine, but the thing that I was trying to point out here, if you go back and look at that first chart that went perfectly vertical, can you see the depression on there? Right? Depression wasn't a big deal. If you go back to the mid-1980s, right? A lot of us in this room can remember that. Brian can't. Can you? How old were you in 1986?
2.
2. Do you remember it very well? No. Not like he's... Well, it's impossible to. But the point is that makes this event look really, really tiny. And in reality, it wasn't adversity. It was a catastrophe, especially if you go back into the 1920s. Again, this is that same graph. I've just made it a little bit bigger and blown up the data so you can see what happened. And I think the thing that's interesting here as we go forward, I'm going to assert to you that a 5-year moving average of land values has never been wrong. At least it's never been wrong in North America, ever. From 1612 until now, If you roll over the 5-year average of land values, it takes a long time to digest it. One of the things in Purdue's webinar was interesting is that the people were asked the question, is there more land for sale or less than 5 years ago? And everybody said the same. That's because there's none for sale. Really, it sells pretty quickly. But the problem is, what if people start thinking it might go down? That's what happens with land values. It's a accumulation of earnings off the land and the cash flow off the land. And so once you roll the thing over, it takes a long time for it to stabilize. And anyone can pick out any reason why they think that might happen. I'm just pointing out that in the 1920s, in 1924, if you would have sold land, it would have been a brilliant decision. Brilliant. Somebody did. There was a lot of land sold in 1924. If you waited to sell it until 1934, you sold it at the absolute bottom. And so the point that we're going to try to make with this presentation is now is the time to take action to manage adversity. We have to manage adversity aggressively. Get out in front of it. Don't let it freeze you. And so we have this signal. It's worked every time. If we go back and look at the 1980 event, worked perfectly in 1980. It would have got you out of the land market in 1982, which wasn't the high, but close enough. And unfortunately, when we come back to here, the value of land in Iowa at the end of 2016 exactly equaled the 5-year moving average. And going forward, do we think land values will be higher at the end of 2017 or lower in Iowa? Anybody from Iowa? They boycotted the meeting. I know. But yeah, so the bottom line is very few people see land going higher, right? I mean, all the data from Purdue says it's going to dribble off another 5 or 10%. And if that happens, we have a sell signal in the land market, and it'll be the third one we've been given in 180 years. It's just something that we should think about as business people. That's all I'm suggesting. And I'm not suggesting you have to sell any land. I'm just saying, okay, let's plan for what ifs. And that's how we manage adversity in advance. So this is just kind of what I've ginned together from business school and training and 30 years now, or 24 years now farming and some GE training before that. And what I'm suggesting is that we haven't seen adversity yet in agriculture. We've just got down to the point where we're starting to feel it. Now, I know Indiana Family Farms is gone. I mean, a lot of the Mike Stamp is gone. I mean, some of those kind of businesses that didn't have a model in the first place except pay up and grow into oblivion are already gone. What I'm suggesting is the normal average farmers are just now to where they're going to have to start managing adversity. We talked about managing costs last year. So what I just wanted to walk through is if you can look at the future and you can see that there is possible adversity coming, then the first thing you want to do is just anticipate it and try to avoid it. Now, you can't always avoid it, obviously. If you talk to my father, as they knew that the top was in 1980. They sold some land in 81, right, Dad? Sold some land in 81. Luckily, well, they didn't know it was luckily at the time, but if they wouldn't have, it made a big difference. Made a huge difference in survivability in 86. And they didn't sell very many acres. That's the thing. And they didn't sell any of the core holdings. But anyway, the first thing I think we have to come to terms with as farmers especially is that my belief that black swans don't exist. And the reason I say that isn't because unexpected things don't happen. Although at this point, I don't know what unexpected could happen in Washington, or in Paris, or in Sweden. But whatever it is, if we just admit that we can look into the future and we should be troubled by the way things are positioned. And so therefore we can see that adversity might happen. A lot of people in this room, especially Eddie, remembers back in 2006 and 7, we were talking about 120% home loans in inner city areas. It's a bad business model. And Bank of America did like $45 billion worth of those And they wrote off $45 billion. Well, no, they didn't. You bailed them out. Taxpayers gave them the whole $45 billion and thanked them for their time. But if we can just admit, what I see happening, and I get calls once in a while from people that have been to meetings or see me out giving speeches, I've got this situation, what should I do? Because we didn't expect this. If you read the media, everyone uses a black swan as an excuse. And I'm just going to suggest that excuses won't help us get through the adversity. So if we just admit that the future is unknown, that it's going to be very variable, and we know that the currency is going to zero, which means volatility has to increase exponentially. It's just math. We want to admit that something's going to happen that we can't anticipate. So if you go back to that first chart, and I should have put it in there more. I should have put it in there more often. This was a 50% haircut in land values, 54% haircut in land values. If we look at what the inflation-adjusted value of land is, it's $4,000 an acre. This is Iowa average farm ground, not the stuff that's worth $13,000 by your farm. But the average, if you looked at price to earnings to land, and you say, well, land should only be worth 18 or 20 times earnings, not the 35 that it is today, then that would be $4,000. So it becomes pretty easy to visualize how land could get to $4,000 because the earnings support $4,000, not $8,000. And just a normal retracement and digestion would get us that kind of a setback. So you see, I'm not projecting Armageddon at all. I'm just projecting natural capitalism. This is what happens in capitalism societies. You race ahead and you get really, really, really excited, and you have the government take interest rates to zero, and you have the government force people to use 40% of your crop to turn it into fuel, which we're not going to need anyway because we're going to go to electric cars. You hear about that from Jack tomorrow. But the point I'm trying to make is it's not a black swan to say that there's some possible dark clouds out there, and so how do we manage it? So the first thing I would say is that there's no reason to go, jump off a ladder. It's pretty easy if land's only going to go down 50% to look at, if you've already got 50% equity in your entire business, including the land, you're going to survive. You're going to have to work on cost control, and you're going to have to delay capital purchases. So for the most of the people in this room, I think Dad's land's portfolio is like 87% equity at this point, or 90. So he doesn't care. He doesn't want to sell it and have to buy it back later, and if he's wrong, pay more. So, he's not going to get in and out of the land business, and Jane and I aren't, and Roy and I aren't, and Rodney and I aren't. What have we done? Well, we've refinanced some stuff. Rodney recapitalized his land, delayed the principal payments out in the future. We only got to get through 2020 or 2023. So you can do that. There's no shame in refinancing something. If you find shame in that, you may want to sell a lot of land because it's going to get really hard in the future at some point, whether it's now or in 2030 or whenever. But the point I'm trying to make is that now, while people like Prudential are calling me, wanting me to refinance my land, is the time to do that, is to get restructured and get your business in a place where you can handle adversity. Because trust me, 96% of farmers in North America aren't going to do that. And the bankers aren't here. So, I'm going to try to skip over that slide about land values when the bankers are here tomorrow. But I think this is the thing that I'm just trying to encourage people to think about. Look at your business, look at your structure, and take some steps now to help manage that. For example, the next one, last year we talked about cost reduction. Again, something farmers don't want to talk about. But if you're going to get into adversity, it's the first person to give up the high rent farm that wins. It's not the last person. Again, these are things that have just not been the way anybody in this room has done business the last 20 years, right? None of us have tried to step back. None of us have had to be the left tackle on the football team. What's the first step a left tackle takes on a pass play? Backwards. And he's got to be nimble, right? So what I'm suggesting is, as we go into this future that looks very, very volatile from any way you can look at it, in my view, we're going to need to be nimble, and going backwards is actually going forwards. But you can't let other people tell you when to take the step back, right? You don't want the left tackle doesn't wait for the defensive player to knock him back that first step, because then the game's over. So we've given up one of our high rent farms, and honestly, as much time as I spend with numbers and finance, I really did not know, but by doing that, my cost of production would go down. That honestly surprised me. And you can say, well, how could that surprise you? Well, because we've been taught, more land lowers your overhead. Well, that's only true if you're actually cash flowing it. And so, I see a lot of guys shaking heads, so you guys are smarter than I am, but it was a good lesson to learn. The other thing is, especially if you're younger, I think you just got to go talk to the landowners and just say, hey, do you want to put me out of business? Just be honest with them. Here's the revenue. Here's the expenses. We're living off my wife's teaching job. What else do you want from me? And just be honest with them. Because, again, we talked last year about pushing back. And Paul got mad at me because I told you to push back on your seat, guys, right? And did somebody push back on you, Paul? You got lots of pushback. That wasn't me that said that. That was somebody else. So, and that's the other thing about this that's interesting. If you go listen to a bank give this presentation, they're going to tell you to sell equipment or to get an off-farm job or to drive a school bus. And I'm going to tell you, you guys are smarter than that, right? Find a way to add revenue, do trucking for somebody else. Just honestly look at your calendar. What are you doing next Thursday? What could you be doing next Thursday? I know the guys from Illinois, right? Fred, the guys from Illinois, you guys don't work every day in Illinois, do you? Most farmers don't work 200 days a year. So find a way to add a revenue source. Maybe give up the high rent farm. Find a way to drive costs down, and maybe give up the high yield lunacy. We could spend a lot of time debating on that, but I guess I would just challenge you to make sure you're getting the value out of your inputs. And the more and more data that Rodney does and the more and more testing that we do, the P in the K can be so low it's incredible and not hurt yields. If you got the soil working, if you got the soil cycling nutrients, which you don't have in conventional tillage. So you got to, we got asked to give a presentation. They want to do a video for bankers about why they should give farmers money to plant cover crops. Why weren't you doing that when corn was $8? That's when you could afford to lose money starting the process. But again, it's never too late to look at hardcore how we're doing things. Maybe if you need a new sprayer, you don't want to spend $250,000. Maybe you've got to pay the co-op to spray for a couple years. Again, first step back, I'm still in balance, right? If you wait for the bank to tell you you're stepping back, you're probably going to fall over. And it also becomes much more, I think even for your family, it's much more mentally healthy to say, everybody get in a room, hey, this is the reality. This is what we need to think about. How do we do this together? Instead of coming back from the bank, they won't approve the loan. That's traumatizing as opposed to managing out of adversity in advance. So that's what and it's really interesting. When I was at Crotonville for GE, we spent 2 days on being in front of stuff. It was never acceptable to say, oh, well, we didn't see that coming. No, that's just grounds for termination. Next thing is, and I know this is a little bit simplistic, but if you go with me a little bit, it's been my experience in our own business that the fear of the real number is a lot worse than the real number. And maybe you guys don't look at the world that way, but in my mind, when things are going wrong, the fear of how wrong it is much worse than how really wrong it is. And so again, we want to take emotion out of this. We don't want to make flippant, reactionary kind of decisions. And so knowing what the real impact becomes critical. Crop insurance makes this a lot easier. I was talking with a banker yesterday. We've been spending $4 an acre for crop insurance the last 3 years or 6. We may spend $40 next year. When times get really tough, if things are going to get really diverse, you want better crop insurance, not less. even though that raises your cost. But your cost after your guaranteed floor, you can at least make that decision as a businessman. Do we want to spend money on insurance to guarantee a higher floor so we survive some adverse conditions? I would encourage you to get help. Boy, there's a lot of people in the world that will help you if you just ask them, including your spouse and your peers and your family and your priest. I've constantly been surprised how just talking with other people about problems makes the problem seem smaller. And it also gives you a chance to listen to other people whose problems are probably bigger than yours. The last point on this that I think is really, really important is you want to build a plan, no matter what the adversity is. And you want to make it believable, and you want to make it something that you can meet, as hard as that might be. Okay? And you want to get that to your bankers as fast as possible. And so what I mean by that is, so if you're in, let's just take our farms in Tipton County, right? Projected average yield of 200, probably going to do 165. I mean, you just don't take 30 inches of rain in April, May, June, and July, maybe March, April, May. It's just not the way it works, right? No matter what USDA says, trust me, that's not the way you grow 250 bushel corn in Tipton County, Indiana. And so you can, the bankers know that we're not planning on, we've reduced our yield on our cash flow projections by 5 bushel the acre back to average. We think we have an average crop. It's really hard to have a terrible crop when it rains every day, and it's really hard to have a good one. So again, but communicate to people what's going on so there aren't any surprises. And so then when you sit down with them the next time in February, you want to say, we met our promises, we met our plan. And even if that plan is to lose $1 million, that's okay. That's what this is how we're dealing with that adversity. In our case, we're paying off tons and tons of principal, so our working capital keeps going away. But our total debt's the same, right? Got to remind them of that. They're also worried about working capital, but the total debt's going down. Then it all becomes just a numbers game. Well, it's not long term. Well, why do you care? Short-term money is cheaper. You get a better margin on it. The bank gets it. Don't let the bank, remember, the banks get much better margins on operating money than they do on mortgages. Don't let them forget that. It's in their best interest to work with us through working capital challenges than to force us to refinance it long. Does that make sense to people? Is that helpful to think this thing through? And again, I think that first step back as that left tackle can be very instructive. And if you go back and look at this chart, and you come back in here 4 years from now, and the value of Iowa land is $4,000 or $5,000 or $6,000 an acre, it's not a bad deal. It's still worth 6-10 times what they paid for it 10 years ago. Eddie.
What is your thought process on why you're paying off long-term debt?
Yeah, so Eddie asked the question, what's the thought process on why you're paying off your long-term debt but reducing your working capital? And that basically is we're paying off the loans as they were initially scheduled, and we wanted to wait until the end of 2017 to see what our working capital position was. So we didn't want to go refinance anything until 2017. And when we look at it at the end of 2017, it's going to depend on yield and price, neither of which are known, at least not very clearly to me, and a lot of other things in terms of how our business has progressed, and a number of other things like, what have we used capital for that wasn't part of that discussion. So in general, we have already refinanced land to string it out. We want long-term debt as long as we can get it. We didn't want to have to refinance like the grain leg. See, the problem with grain leg loans, and you guys know this, it's criminal that they make us pay them back in 7 years. There is no way that asset can pay for itself in 7 years. It's a 20-year asset that costs $700,000. So the bank's own rules force me to be $500,000 upside down on working capital. And I pointed out to them, and I'll point it out to them tomorrow. It's your own fault. But, so we may have to come in. We'll just see how things are going. But in answer to your question, it's a great time to go get liquid. Long-term rates for land are still pretty darn low. You can call Prudential America. They'll do 50% of value for like $900 for 20 years fixed rate. So I would encourage people to make sure your business has enough liquidity to get through some tough times. And if not, it's a great time to add long and pay off short. Don't add long and buy something. That seems obvious, but some farmers get tempted. And so just another example that helps make this point, I think that's helpful. Dad's bought a farm on contract. So we got 4 payments, pretty big payments. So we're going to go out and finance the entire payments, the 4 payments, and keep the 3 payments in the bank. Loan them to ourselves, pay him more interest than he's paying them, and it's a big win-win. So it gets us more liquid without using our total debt position. That's what I really don't want to have to see. In my mind, when I think about debt, as long as my total debt's going down, I'm winning the game. And if we can do that through $350 corn for 3 years, that's pretty darn good in the big scheme. Because it won't be $350 forever. Something bad will happen. For all I know, maybe it already did happen, just nobody knows it yet. But so that's kind of the thought process. Any other questions? That was a great question, Eddie. So the last answer to Eddie's question, people like Beck's hybrids, I've told them they should mortgage all that 15 or 20,000 acres that they own and just put the cash in the bank because they may need it. People don't think about this. I mean, Paul, right? The seed invoices per customer, $500,000. Pretty easy for some big customers. 1 or 2 of those guys get in trouble. The seed industry could have working capital problems in a real hurry. So if you're in that kind of a position, I think it's good to get yourself liquid, get the money, get the cash available. So the next thing that a number of the new guys that have driven in a long, long way to be here, and we really appreciate it. This concept of when do we implement selling multiple years, and we do that based upon the basically all-time price range of the commodity. So we started doing this a long time ago at this point, but this is just the corn chart from 1970 over 1993. Everybody knows that in 96 we created a new range. But we used this chart a number of times through this 18-year period to make the decision to become aggressive in selling when the prices are in the top, when they're above the 0.618 of the range. So just a couple of definitions for people who are not aware. So that's the high price, the low price, $1.08, $4 in corn. It used to be really easy. We'll go through it now in a minute. It's not as easy. But if you just look at this chart, basically, whenever the price got above the 3/4 of that range, you want to be selling more than 1 year. Now, that doesn't mean you want to sell all of this year's crop. You may want to sell parts of a lot of different crops into the future. But if you look at selling when corn hit the, and this line couldn't have been drawn until after that day. So if you look over in here, when we get into 1980, when corn gets up above 327, up to 360, you want to be selling 1 or 2 years or 3 years worth of crop. And the same thing in 83. If you could, back then you couldn't sell 86 corn. Dad was pretty sure times were going to get really tough, but there wasn't anybody who would buy his 1986 corn in 1983. And now I've got 5 or 6 buyers that'll buy it. Now, of course, it may only be at $3 and not $4, but if it's going to go off the board at $2, it might be a good idea. So what we've tried to use as a standard is whenever the prices get to the 0.618 of the range, we want to sell a first year's worth of crop, and we want that to be too early, and we don't have a price target. You guys have heard me rant and rave about not using price targets, but when we get to the 0.618, we start implementing our selling triggers, and that might be just the previous week's low or the previous day's low, and a lot of times the market will just scream straight north, and you don't get it sold until you get even higher. But we just want to use that as an indicator, as a tool, to help remember that when corn gets back to 550, that's expensive corn. And that as growers of corn, we want to be selling it. And so for me, it's always been very helpful just to have those numbers on the chart. And the other thing is, someone may say, well, why do you think corn's never going to go above $8 again? Oh, it's going above $8 again, but it's not until 2035. I'm worried about the corn I'm going to ship in 2018. Okay? And you can say, well, we're going to have hyperinflation. Yeah, and if we do, we'll have depression 12 months later. Okay? So the fact that even if we go into hyperinflation, the system's going to melt down. So maybe selling that 550 corn will still be a good thing. And all we're really saying is that for our business, we've decided, when corn gets up to the 0.618, we're going to be aggressive, and if it would get up to the 0.875, we're going to be very, very aggressive, and if it tests the old high, we're just going to be super aggressive. And we'll go through a little bit how we do that. So that's the old corn chart. That was easy. Put into perspective, we were trading about 100,000 contracts of corn back then versus 1 million now. And so when you come to the corn chart that's right now, you can see this is the high at $8. And I just used some simple math. This is that old range I showed you. And so you can, when you look at this chart, 180 to 780 is a nice range to use, $6. And if you look at that range, then you wouldn't start selling until you got to 550. And so I've kind of arbitrarily made the decision that this whole event in here was bogus. I mean, it was 2 droughts back to back and 2/3 of the Corn Belt. Probably never happen again. But if we get to these price levels, obviously we'll be selling. But what I've tried to do over here is look at what is probably a more realistic price range. For those of you that have been following me for a long time, I've said forever that the high-end corn should have been $6. Only reason it got to $8 is we allowed unlimited speculation. We required 30% of it to be crushed for ethanol. And we took interest rates really low all at the same time. So if you throw that all in there, and then we have 2 droughts back to back. So if you just say that, well, maybe that number progression of $6 makes some sense. So I've just placed the high of this range at $5.84, $6. And you look at those numbers, and they can have some meaning. And the 0.618 of that range is the high in 15 and the high in 16. And of course, this year we just made it back to the 0.5. Now, if you look at the low in that range, it's 0.25, which is where the markets tend to come back to. You guys have heard me say that over and over again. So Eddie asked the question at last year's meeting, how do you decide on what these ranges are? We try to let the market decide what those ranges are. And so the way the corn market's acting, this is the right range. This never happens. And obviously, if we have another drought like 2012, corn will probably rally $3 in 6 weeks. But if you're implementing triggers like we talk about doing, you're probably not going to sell the first not going to sell much of it at 438 if it's trading at 490 the next day. So again, we're trying to put decision-making tools into place that can be there. They can be there for my kids, right? A lot of this stuff isn't going to go away. A lot of these ranges aren't going to change anytime in the near future. It's just a nice way to have something in place so that if, next summer corn does get to 536, we can remember, well, gosh, I know it's not raining and I may not have a crop to sell. We'll talk about that in a minute. But that's a really good corn price. So that's the corn price. So the ranges that I'm going to be using are over here in this 430, 440. Anyone know what the perfect pitch is in music harmonically? It's 440. And it's not at all surprising that 440 would show up in that chart, and it's not at all surprising that 440 would show up on this chart. Again, so that's the soybean chart. Soybeans are a little bit easier because their move was so much more direct, and you can say, well, gosh, you've always used $18 for the high. I put these new charts together for this year. I'm trying to couple the reality of the situation with how it worked historically. And whether you like it or not, agriculture is over-investing about $30 billion a year in R&D we don't need. Now, the seed companies don't want to hear anyone say that. But that's the reality. And you're forced to pay it whether you want to or not, at least in North America. We're talking with Abex, one of our favorite varieties is 5140HR, which is a single stack, one corn borer trait. And we have no corn borer in the field and no rootworms. In the Eastern Belt, I don't know about you guys out west, I'm not speaking for you, but where we're at, and Pioneer has told them, Pioneer's not going to release any more single trait genes to their ProAccess customers because they're going to make them buy 2 traits so they can charge you twice. And if you don't like it, they don't care. Now that's called monopoly in the real world. And it won't be enforced. But anyway, so those are the things. We are way over investing. I know the whole world says we're going to starve to death. I'm just telling you, that's not the reality. I don't think Shane Meyer is here yet. I didn't see Shane come in. He just put in drip irrigation on 300 and some acres in southeastern Indiana. So he took 150 bushel corn ground and made it 250. All to grow $3 corn. Why? If we only get $3 corn, he's got a 13-year payback. If we get $5 corn, he's got a 6-year payback, right? There's a big story, and I think Corn and Soybean Digest, guy in southern Illinois or Kansas putting in drip irrigation just so he can grow more bushels. And he used a 7 to 10-year payback. That's not good enough for capital. Especially if you only grow $3 corn, it becomes a 16-year payback on tape that might last 20 years. They say 25, but that's a pretty small emitter. That's a lot of water. That's a lot of years. So the point I'm trying to make is that the new reality is seemingly, and we kind of do some of the definition for this, is we're getting way too much production around the world. Second, Brian. You go to Ukraine. None of those acres are going away because Cargill finances all of them. You go to Brazil and Argentina. They keep expanding acres because China and Cargill and Louis Dreyfus are financing all of them. So I'm just trying to make the point and try to explain why we would use this set of numbers and not this set of numbers. And especially in the corn, when I thought corn should only get to $6, and I've said that back in 2001, when it went to 8, that was confusing. And now I'm just suggesting that if you look at our business model, and you couple with that with how volatile I think the future is going to be, I'm more than willing to start selling the second year of corn at $5.40. More than willing. And I could be completely wrong, and that's fine. And you guys wait and sell it for $8, and I only make $1 million that year, and you make $3 million. I'm quite fine with that. Yes, question?
Wouldn't that be a similar return on investment to tiling?
Boy, that's a great question. Is that a similar return on investment to tiling?
I guess here's my question. You guys are slowing down on putting in 5, right?
We are not, but we're not putting it in for that amount of money. So they got $1,200 an acre, and I can, on my own field, do it for a lot less than that with our own equipment and our own people. That's a great question. I mean, I would have to set, in our case, most of our tile is paying for itself in the 3rd and 4th year, even going up the side of the hills. So that may just depend on your system. If you're in conventional tillage, your payback from tile would be less than in my system. So really would need to run the numbers and see. That's a great question. Yeah, great question, Eddie. No, it's when the upfront gets to $540. This is the front month contract. And yeah, you're going to say, well, these 19 may only be $440. Right. But if we get the front end to 540, it's going to go, East 19 may go off the board at 240. And so I'm using the front month price to make those selling decisions. I think I've got a chart in this packet where I'm looking at, like if you look at Minneapolis wheat right now, the market went inverted like it always does. And it was pretty darn easy to make a first sale of 2018 Minneapolis wheat around the 4th of July at 640, you know, for the guys that had just sold last year's crop at $4. So I'm suggesting that in ag and in commodities, something will come along and mess up one of these commodities and we'll get a spike and we're going to want to take advantage of it. So I'm using the front month to define those prices. And everyone always tells me it is so hard to sell the discounted deferred. And I say I know, and it's always the right thing to do. Because remember, when you guys look at the commitment of traders report, what's the largest position taken usually? It's spreading. It's not long commercials, and it's not short commercials, and it's not long funds, and it's not long index funds. It's spreading. And if you want to sell the front end and buy the back end and play that spread game with those guys, you know, that's a whole different industry. I don't even know anything. I don't even want to talk about that. But in terms of making cash grain sales, whenever the front end corn market gets to 540, whatever that December 18 corn is at is probably as high as it's ever going to get, right? Now, okay, so you say, well, yeah, but what if we run on to 774? Well, again, we're going to try to ease into this. You know, we'll do a little bit each time. We're going to try to use our triggers so that hopefully, you know, I mean, all kinds of things could take corn from 580 to 740 in 10 days. And you're going to say, what kind of things? Well, again, there aren't any black swans. Nuclear detonation. Is that potential? Well, sure it is. Even if we blow up Korea's missiles, they might detonate one in Korea and make it look like we did it, right? I mean, the world's a crazy place. So, you know, you could do that, but if you're going to be using triggers that are kind of scale up or follow up triggers, you may want to sell it at 540, but you may not actually get filled until it gets to 740. Does that make some sense? Is that a good answer? Or? Jim, you had a question? Yeah, so you're saying you're getting all the money back out of your tile in 4 years, 4 to 5 years, and gets the money back out of your equipment that you're doing it with. So, again, I think where Jim's at, the dirt needs it worse, and I think you're in some better soils, Brian. If you go up towards, you know, Lafayette and west into some of those soils that have natural internal drainage, get some friends up there that don't get a payback on tile for 7, 8 years. So I mean, it does depend on the soil type and the rainfall pattern you're in, and you know, a million other things. But for us on the white clays anyway, we get the money back in 4 or 5 years. And then in a wet year like this year, in certain parts of that field, we get it all back in 1 year. And we've had 3 of these wet years out of the last 4. So it's for wheat. You know, we have the same thing, and I used to do one of those presentations where I talk about mistakes that were made and things that were obvious. And so what I've started doing on some of these charts for some of you guys that have been around for some time is I'm going back and looking at the entire contract history of the commodity. In this case, we're looking at Kansas City wheat. And I've added these dashed lines at what are extreme positions by the players, okay? And I've done that because I've missed this one 4 weeks ago. I didn't do it. I didn't realize how bizarrely long the specs got in Kansas City wheat and how bizarrely short the commercials got in Kansas City wheat, all in 2.5 weeks. Remember, we've talked often about in the new environment of money flows that the specs are going to buy everything the first 10 to 14 days. And so what was wrong with the price of Kansas City wheat wasn't that the specs didn't buy. The specs bought it. They bought 500 million bushels of it. It's just that the dumb producers sold it all too fast. Which isn't right, is it? No, the producers got out from underneath the inventory that they needed to get out from underneath. So the bottom line is there's just an awful lot of inventory of wheat. that's now owned by speculators, and the commercials will start buying it all back right in here somewhere because it's back at value again. But what I was trying to point out is I completely missed this. If you were on the website, we talked about don't get bullish Minneapolis wheat after June 30th. And maybe I should have been screaming sell, 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 but I don't deal with Minneapolis wheat, or maybe even isn't the other wheats. But see, I really thought the wheat would take a shot at 620 or even at $7 on its first leg up. If you just look at the range and what normally happens in the past. And this year, what actually happened was we had the speculators buy all of those bushels of wheat, and it only moved the price up to about 540. And this is one of the reasons that I went back and looked at those corn and bean charts and say, okay, let's think about this. And if you go look at the corn and bean charts, same thing happened, right? The commercials sold, I forget how many 100,000 contracts of corn on a 17, 18 cent rally. Just crazy amount of commercials hedging. And that's why corn didn't make it to 450. It didn't have much to do with how much money flow happened. The money flow still flowed in. It just didn't get a price response. And you could argue that's because the crop's there or the crop's not there. I don't know. I'm just saying we've added this as an additional indicator to, whenever we have something like this happen, as producers, we just need to get defensive. And so, yeah, when the wheat market turned down about 2 weeks ago, or 6 weeks ago at this point, 30 days ago, we should have been all over it, much more so than we were. Not because the price couldn't keep going up, but because the speculators had bought all that they can normally buy. And these dashed lines merely represent where they stopped buying. I wanted to go back. Yeah, see, I took all those other indicators off of these charts to try to keep them simple for teaching purposes. But when we get into the slides tomorrow morning, the big picture slides, we'll be able to see that just how much of a transition occurred in terms of ownership of the commodity in a very, very short period of time. Kansas City wheat's a very interesting one. Chicago wheat, the commercials are still long, which is fascinating, but if you look at the spreading, there must be a whole bunch of spreading between classes, which is not reported by who's doing the spreading. So let's just take this and flip it over another way. So we're talking here about price, and I'm a timing guy, so maybe we should just ignore everything I just said. But I did want to take some time and explain what those red lines mean on the chart and what they mean to us in terms of managing our risk. And then we want to flip over and talk about time a little bit. So for the guys that have been around for a long time, you know that these green arrows have been on this chart for 5 years, and going forward, they're going to be on the chart for 5 years. And you can see that sometimes we miss on the price target, but the time has been relatively consistent with what we thought would happen. And so, last year we talked about being careful about expanding in the hog business. And since then, we've had an entire year of cover stories about how optimistic everybody is about the hog business. We're building all these new packing plants. We're going to run out of pigs to kill. And packing plants are a little bit like grain elevators. You actually don't have to use them. You can turn them off if you want to. You can turn off anhydrous plants if you want to. We went to Lorain, Ohio this summer, which is where my wife's parents are from, and laid them to rest. And you guys really, as farmers right now, you should drive to Lorain, Ohio. Get in your car and drive downtown. And look at what happens when technology destroys your industry. It might as well be a city from East Africa. Big block buildings empty with the windows shattered. And of course, in the government's wisdom, in a town that has way too much real estate, you build Section 8 housing 13 stories tall on half an acre. Who dreams this stuff up? Anyway, but it's very educational to think, and around here, just drive up and down our road, you see an awful lot of chicken houses that are still there. Haven't had chickens in them for 30 years. You can see a lot of hog houses that are still there that haven't had hogs in them in some time. So all I'm really trying to suggest is, you know, we thought we'd have a high in hogs this summer. We've had the high. We just don't want to be taking any price risk in the hogs, and it's all based upon timing. I don't think the price is high enough. I'd much rather be hedging hogs at 80 cents or 70 cents and not 60. I'm just suggesting that the waves and the timing, and this is the 80-week chart. If you look at the 80-month chart, boy, between 18 and 20, the hog business could be an awful lot like 1998. I mean, it's not an accident that it's 20 years later, and it's certainly not an accident on my charts that it's 20 years later. It has to be 20 years later on my charts. So, yeah. What's that? Boy, I've heard a lot of people smarter than me try to explain how that's calculated. And what I'm saying, for our decision-making purposes, we only look at the 80-week cycle. 80 weeks. You know, if I had the computer here, you can take these lines and go back 35 years. They've always been important, and it's been kind of amazing. And you know, sometimes it's not exactly perfect, right? I mean, this washout should have been higher than this low, but it wasn't. But the time of the wave was the same. The rally back into June, notice I was saying here that the high was 6 weeks late. You go over here and you can have a double top over the time, which actually makes this really, really easy right here. That's the easiest pattern, not the hardest. Everyone thinks that's the hardest. So on this particular chart, to answer your question, I use 80 weeks. And then I think you got to just admit to yourself that you've got to give yourself 1 or 2 weeks to be wrong. You know, tomorrow we'll look at the Kansas City wheat chart, and I had a big purple diamond on there for August of 2017 for 6 years, and you know, July 4th of 17, so you're off by 24 days. It's kind of frustrating that the market tops early in that situation. It makes it almost impossible. But yeah, 80 weeks, but if you look at the 80-month chart, it's the similar, but that just becomes so long that becomes more than a lifetime. So the other thing that I would just throw in there as well, you know, there are all kinds of planetary cycles that roll around. You know, everyone talks about the 27, 28, the 54-year, the 19.8-year cycle that Browning developed 100 years ago almost at this point. You know, the 19.8 years is just the Jupiter-Saturn loop. There's nothing magical about that. So I don't necessarily go to astrology. I just go to math. And so it takes people time to respond. We just had an eclipse. Is anyone surprised this is the first eclipse in history to cut the United States in half? Did anyone else know that? It's the first one since the country was found that went completely across the continental 48 and cut it in half. I don't know if you guys know this. I think our country is pretty polarized. Is that an accident? I don't know. It just happened at the same time. But when we look at the cycles, we don't try to explain why. We think it's all human psychology. We think it takes time for a man-animal to respond to things. In the first part of this presentation about adversity, we think it takes most men 18 months to admit that they have a problem. Women are a lot better. They would admit to it in probably 36 days. So if your wife's worried, pay attention. She probably knows what's going on. Because she probably can tell you're worried and you don't want to admit it. So let's talk a little bit at this point about some of the tools we need. That's pretty funny. I'm looking at a watch that stopped working. You guys are going to be here for a long time. Oh, shoot. So when we come back and look at these charts and say, well, if we get a rally in beans back to 1140 or 1280, how are we going to manage that? And we had a rally last summer back to 1140, and we didn't do multiple year selling. We probably should have. We did sell all of the 16 and a lot of the 17 in that window, so I guess we did do multi-year selling. We sold a lot of the 17 in January. You guys are all very familiar with that. Someone asked me, how does it feel to be so wrong in the markets? And I was like, man, have you guys followed the soybeans? We've slayed the soybean market this year. And you're never going to be right in everything all the time. But when you get to this point, it's pretty hard for us farming 6,000 acres here in one spot, just to call up the futures broker and say hedge, what's 3,000 times 60 bushel beans? Just hedge 200,000 bushels of beans for us. I mean, Brian, and it's easy to work with, and Jordan, but they do expect you to margin the position. So we want to talk about tools, about how we do that. We've talked about this in the past, but the one thing I wanted to kind of walk through. So let's say that this bean crop isn't out there. Let's say that a few of us that think that the weather that we've had in a big part of the belt is not conducive to record bean yields, which is what I'm calling the USDA forecast. I know we had 52 last year. You go look at the water we had last year in the bean belt versus this year. Last year was an aberration. So anyway, but if we would for some reason this winter be able to run beans back up to 1142, so what are we going to do? What are we going to do about it? Well, we're going to start following this plan. And this is the thing that we wanted to talk about a little bit, especially for newer people. The Cargill people will be here tomorrow. We're doing a little bit with the Andersons. We've really had trouble getting the Andersons going because the Andersons as a company is just not real sure they want to deal with people like me, because they're not sure they want to be my margin agent. Is basically what it comes down to. So they're thinking about it, and we have a couple 100,000 bushels with them. The rules are a little bit tougher with them than with Cargill, so I'm going to use Cargill for the presentations. Well, let's say November soybeans are trading 1142, and let's just ignore the fact that all of my beans are going to Bex, so I can't sell them this way. I've got to sell them to Bex. But for sake of argument, they're commercial soybeans. And you guys, I don't know about you, but most people that I know, if beans get up to 1142 this winter, what are they going to say? What's that, Fred? Brian's too mature for his age. I'm going to ignore his answer. Well, they're going to 1280, right? Of course, because the crop's just not out there, and Chinese demand is incredible, and Brazil's going to have a drought too. And La Nina's started. You guys know La Nina's back. Very bad for Brazilian fields. At least if you're bullish, you're going to say that. The last La Nina that we had, Brazil grew a record crop, so none of these rules are hard and fast. But your answer was sell, right? At 1142, and that's probably the answer that I'm thinking I'm going to try to remember. I'm not going to sell the world, but I think it's a great place to start. And so, one of the things that we always think about is you've got to think about capital, you've got to think about the stress you're going to put your business under. And so for us, the first 25% is all just going to be a straight cash contract to Cargill, whether we set the price, or we buy it in the money put, or we do just a straight cash contract, or we use an averaging product. That kind of is all decided based upon what's going on at the time, right? Like the Pacer Ulster contracts, those are just the ones that average up, right? You pay like 30 cents a bushel, but if the price goes up, you can lock in the higher price later. And in essence, they're just selling you a call, but you get a floor kind of. It's like it's an expensive minimum price contract. But we're going to start off with just a contract like that has no margin exposure for our business. But we do have a delivery commitment. So it's a cash contract. A lot of times we'll even fix the basis on those if we think it's pretty tight. We've fixed some basis on the 2017 corn already. And rightly or wrongly, I got a call from Cargill, hey, we'll give you 0 under for your January corn. Do you want to deliver any? Well, I have to deliver some. I just have to, because I have to have some cash. And so for us, 0 under at Cargill was really about as good as it gets for January, unless we've had a total crop failure in the east, which we had a couple, 2 or 3 years ago. But so we went ahead and booked some of the basis on that and applied that to our first contract. So those are all over $4. So it's not going to be a terrible year on the first corn we deliver. And then the next thing that happens, so that's our first pricing trigger. But the thing that we do that's a little bit different is we immediately do a contract on the next year's crop. And in my discussions with Cargill and the Eastern Region managers, when I do a contract for 17 corn, they have almost no customers in the world that on the same phone call do a contract on 18 corn or do a contract on 19 corn. And so we're looking for a competitive advantage here, or competitive differentiation where we're all growing the same yellow corn that's not worth much. And so I would argue that while I've got them on the phone, is the single best time to make that first sale. Now you'll notice here, with prices at such low levels, I might only do 10% for 18 and 19. And so you can say, well, that's not enough. Well, I'm just saying, I'm starting out, if I go back to this corn chart, and I'm starting out at 440, when corn could easily, if we go back to the old range, get to 630, all I want to sell is 440. Because if it does top out there and go all the way back down to 240 or $3, the 440 is still a great sale. So that's one of the things that I don't think I've made clear in the past that we actually do. So if you ask the Cargill people tomorrow, they're going to tell you, yeah, when beans had the gap down at 10.12, and I said we just got to put the hedges back on at 10.12, even though the timing doesn't seem right. We sold some 2018 beans that day, but we'll buy a call and then price them sometime in the future. But I think we were the first 2018 beans that they booked. So again, we want to be a little different. We want to be out in front of it, and if we get the run back up to higher prices, we want to start pricing things, because if you look at my cost structure at 440 corn, my operating margins are about 35%. We don't want to get too greedy in this business. And that's one of the things, if you go back and look at this hog chart, I'm sitting here moaning and complaining about hedging $70 hogs. I'm making $38 a head at $78 hogs, and what am I complaining about? Right? This is where price and human psychology really messes up your mind. I'm complaining about a 35% profit margin growing a silly pig. Yeah. Well, yes. Yeah, I don't like the fact that the packer has pretty good margin control on his end. Yeah, that's right. Yeah. Yeah, and this is the question, with the new plants, are the packers going to reduce their margins? And I would argue in an industry with 3 players, no. Why would they? Has Monsanto decreased the tech fees? They should. They won't. Will DuPont? They should. They won't. Will Chem China? There's an interesting thing. Why should any of us pay Chem China's tech fees? They're not paying Roundup fees in China. I think we should not pay and let them sue us. Well, we'd lose, so I'm not going to do it. But the point is, you think about the unequal playing field around the world, and you can certainly get frustrated with the fact that the hog packers have made $40 a head every year now for 4 or 5 years in a row. You pass part of it to you, right? Yeah. So again, that's one of the reasons we want to use these price ranges to help us keep our sanity a little bit, because we do know, and this is that chart in Kansas City wheat that I was talking about. We do know when the prices take off that all of us don't know how much we have to sell this year. We all just need to admit in your business plans, you don't know how much crop you're going to grow this year. You'll notice I haven't mentioned crop insurance once. I don't believe it has any role in our marketing program. Just ask people this year or last year who sold none of the crop because insurance was going to bail them out on price. That's not the way crop insurance works, because your coverage ends in October. And if the prices continue lower, as it did in wheat and a lot of other things, you don't have any insurance. So we use those as kind of guideposts to wake us up. They're in our business plan. The bank knows about them. All of our family members know about them. And you know what? It's not really hard to have much of a discussion with your business associates and your stakeholders that says, when wheat gets back to 705, we're going to sell 25% of this year's crop We don't know how much that is, so we'll sell some. We'll guess at what 25% is based upon the damage, and we'll sell 10 or 25% of next year's. Again, we're just trying to take emotion. We're trying to make it a little mechanical, but we're also playing math in our favor, right? I always tell people I can't stand to go gambling in Vegas, because if they can afford those beautiful, shiny buildings, somebody paid for them, and it wasn't the casino owner. So, every farm, this should be different for every farm. If you have contracts growing non-GMO corn for somebody on the river, you're going to have to redo this. But what I am suggesting is before the growing season gets here, before the Minneapolis wheat crop failure gets here, you need to have this stuff written down so that you can just pull it out and say, gosh, back when wheat was $4, I said I was going to sell some 2018 crop if it ever got back to $7 or $8. And then when you call them up to sell a few bushels of last year's crop you still have in the bin, sell some of this year's and sell some of next year's. It's not as painful as it seems. But every farm, this should be different for every farm. And the last part of this that becomes interesting is, if you look at this, and this is hard to explain to people. I can't even explain this to Anderson's. White Cargill lets me do this. But you got to develop some deep relationships with people. For the third 25%, we're just buying deep in the money puts and attaching them to a contract that's priced. So we don't have delivery commitments, but we have the price protection. And then we seldom will ever do more than 25% of just one crop in the futures account. I mentally am not tough enough to handle that because the margin can get extreme. Yeah.
Brady and I were talking about that one time. What does that cost?
3 cents a bushel. Well, they'll do it for me. I hesitate to say they'll do it for everybody, but so our deal is, if they do that for me, and I actually make use of that feature, and I actually grow the bushels, I have to sell them. I have to create new contracts for the 25%. We got into this because in 2011 or 12, we had 75% sold. We grew 69%. Having them cancel the contract, they don't like to do that. They'd much rather do it this way for us, let us take a big hedge position, and then we write new contracts once I know I have the bushels. So what's that really cost me is 15 cents, because the poet bids 12 cents better every day. So I'm paying them 3 cents for the put plus 12-cent basis that poet doesn't get. But I'm getting 25% hedge with no margin that the poet won't even talk to me about 2018, let alone 2017. I mean, they don't really talk about 2018, let alone 2019. So from our perspective, it's a really good way that when we have a spike in prices to capitalize but not put the business on the line in terms of if something crazy does happen. So we talked a little bit ago about, it's no longer a black swan that we could have a nuclear detonation. So if we have one, is that bullish or bearish? It depends on where it happens. What if it hits Japan? You can almost throw something from North Korea to Japan. What if they take out Japan? Is that bullish or bearish? You're thinking about this too hard. Is it bullish or bearish? It's extremely bearish. Corn's limit down 3 or 4 days. After its limit up 3 days. Right? Because everyone's going to think the whole world's going to die of nuclear poisoning, which none of us will. We'll all get iodine tablets and we'll all feel bad and we'll die a few years younger. But the bottom line is you just blew up America's second biggest export customer. And they're never coming back, at least not in this cropping cycle. So, yeah, the point there is, though, if you go back and look at Chernobyl was bullish for 7 days. And then they realized, the world didn't end, and the prices were the same place 14 days later they started from. So you don't want to have this margin, because in this environment, especially with expanded limit, that means corn could be up $2.30 in 5 trading days and down $2.30 in 5 trading days. And Brian, if the margin call is $250,000, do I have 1 or 2 days to make it? Yeah, you guys are pretty tough on $250,000. They'll let you slide on 4,000 or 5,000. Yeah, so this is what I'm getting. See, we want to avoid, Brian, contracts that do that, put us at risk for that, and so we've worked this out. Now, the other thing that's interesting about this, like for our seed beans at Beck's, at Beck's we're guaranteed 35 bushels per acre yield if we don't grow any, so you can sell 35. If you don't grow them, they're going to get paid, and then they're going to work with me. If I give them every single bushel I have, they're going to let me roll it out till next year. I mean, they're going to be practical about it. Peter's pretty sharp. He doesn't want to blow up a 50-year customer. So, yeah, but again, I think this is the thing that we want to really think about how we do this and how we position the business so that we don't put ourselves in duress that we can't handle, but still capitalize. See, if you go back and look at this farm in the 1980s, Dad and Doyle sold some land in '81, which became a critically good decision. They came back from a Jake Bernstein seminar and said, let's sell off those house lots. And then if you look back, they had cut costs a lot in '83. They were worried about the future. And then we grew 91 bushel corn in '83. And we didn't have crop insurance in '83. And there wasn't any way to sell the '85 corn in '83 at $3. So it became very, very tough for them. Even when you looked back in '86, and we knew this was going to happen. But there wasn't a way for them to really manage it. So we've spent a lot of time in our business trying to overcome those weaknesses and hopefully not create too many in addition. So again, I'm a timing guy, and we want to talk a little bit about the Kansas City wheat chart. We've had this chart up there for a long time, and again, if you look at the commitment of traders, which we looked at, it should have been the tip-off that this wasn't going to race up to, for me, it was so easy to see Kansas City wheat getting to 670 where this gap is. That gap's going to be like a concrete wall if it ever gets there. And, the bottom line is we just overwhelmed the market with supply about 3.5 weeks early, which is frustrating. I think I've said in the past, if you go back and do this, you got to be willing to move them forward or backward a month. And this year, it just came a month early. And the other thing that happens when this is happening, what's happening? Corn and beans are volatile as heck, right? And I really don't care about Kansas City wheat when corn and beans are volatile on my farm. So I just wasn't paying attention. Yeah. Well, so Eddie's question, why is it not possible that we're printing a low in August and not a high? Boy, I hope that's what's happening. That would just be fantastic. And it is absolutely possible that it is. The only way to tell you the answer to that is what's wheat trading for in March. You got to wait and see what happens. And if that is the case, then that's the exact chart pattern that we just had in Minneapolis wheat that we just took $2 out of the market in 13 days from. And we'll be there. Okay? Because if that's happening, it's going to show up. How's it going to show up? The commercials are going to buy all this wheat back in the next 2 weeks. All of it. The commercials got to get flat again if that's going to be what's happening. We have, and see what that means is that's defining value. That means the whole world's decided that these less wheat acres matter. The carryout in wheat's down quite a bit, and right now, see, the end users can get away with saying, it doesn't matter. It's all there. It's all rotting in piles. It's like the wheat in China, right? All that wheat in China, most of it you can't even feed to your dog, but it doesn't matter. It's there until they need some, right? That you can actually eat. So I'm not going to discount that, Eddie. The corn and the bean charts should have a move higher. The volatility's been extremely low, but we just have to wait to see that happen. And then the commercials haven't been buying fast enough yet. So maybe we just got to go sideways here for a month or two. It's not like that's the end of the world. But the one thing I did want to point out while we have these charts up is we just can't get away from the completion of these big time counts out in 2020 and 2022. We talked a lot last year about 2020, and we're going to talk a lot this year about 2022. Um, and I don't want to. I think adversity creates opportunity, so I'm kind of excited about the future. I'm kind of tired of people that don't know what they're doing, profiting from their ignorance at my expense. And so I'm excited about what this portends. But in answer to your question, if that's what we're doing, then we're going to have a high over here in August of 2018. And we better have the 19 and 20 and 21 sold, because it is going to be ugly. Okay, it just has to be. It's just a math of it. So I really hope that's what's happening. That's why I put the 24 on here. Thanks for pointing that out. The rally in Minneapolis wheat, as we all know, was 24 weeks. It was almost perfect. So for whatever reason, the multiple of 12 is permeating, and I like to see that. So yeah, if we can just take this sideways in here for a month or two, I can get pretty excited. Question, are Kansas wheat farmers going to plant hard red wheat next year? Are they going to keep producing acres? I have no idea. If they were smart, they'd keep producing acres and take the crop insurance on corn or beans, but I don't know if they will. But if they do reduce acres again next year, so it'll be the second or third year in a row that we have less acres than ever of wheat, we certainly are set up to have a bullish response, because the supply and demand does keep getting tighter and tighter, and sooner or later, something good happens in ag. Yeah? So this is an entirely different time count up here. See, see these red lines, they're calculated differently. If you go back and look, boy, you're going to call me out on that. Yeah, so if you look at these counts, these green bars, that's the 114-month cycle in wheat, which has worked really pretty good over the years, especially in Kansas City wheat. We went through that all last year. You go back and look at last year's slides. From the creation of the Kansas City wheat contract, 114 months has been important. It's shifted a month in here, kind of frustrating. But this is based on 144 months. So we're looking at multiples of 12. In beans, we always look at multiples of 12. In hogs and cattle, we always look at multiples of 12 in the Fibonacci sequence as well. And so I just put that up there as a second calculator that's a little similar, but dissimilar at the same time. So they kind of become, if you think about Fourier transforms, which is where you put a whole bunch of waves, this wave with this wave with this wave with this wave. When you get rogue waves in the ocean is when you have the crest of like every single wave at the same moment. That's what a rogue wave is. And so when we're studying timing in the markets and thinking about human psychology, when you have those waves all kind of come together at once, you get 2012 and you get $18 soybeans. And so looking at wheat going from this high back in 2008 at 1350 on this chart, it varies on which chart you use. We're just saying, so well, let's just, and that was 144 months up from one of the main lows. So let's just count forward in multiples of that and see where it comes out. And interestingly, you have a big cluster out here in the spring of 2020. It's pretty hard to imagine that being a high. If it is a high, then we have to respond to it, and we sell the 21, 22, and 23. And it won't. If it's a high, then this will be a low over here in 2018. And the one thing that is hard to, when we do timing analysis, think about is as a market comes into a timing point, you got to go with its momentum, right? In Minneapolis wheat, it was obvious that June 30th had to be a high. I mean, it was going up every day going into it, so it can't be a low. And the same thing out here. If we chop sideways all the way until harvest of 2018 and build this massive base, the odds of wheat going up in 19 are pretty high, right? So that's kind of we kind of have to respond to what the market's given us. I was accused once when I was speaking in Iowa of being extremely arrogant if I thought I knew what was going to happen. And what I've tried to communicate is I admit to myself that I don't know what's going to happen. I just know when something should happen. And that's what tries to make us a little different. And as we go forward, we try to capitalize on that as a way of thinking about it, especially in a time when you have instantaneous money flow of hundreds of billions of dollars. You can't react to the computers. You have to react before the computers. So if we just go to look at Minneapolis wheat, when I did that analysis back in here, I think Roger called me and said, what do I think about Minneapolis wheat? And I did this analysis, and that's the one where I had the great big picture of a bull at the end of it, talking about. So in this particular case, the Minneapolis wheat made a higher low this past spring as the 180 count expired. So it's kind of like what you're saying might happen in the Kansas City wheat, Eddie. Certainly could happen. And so you have a higher low at the time count. Tomorrow we'll talk about crude oil, had a lower high at the 180 time count, half a circle, crude collapsed. I mean, the whole global petroeconomy collapsed after that happened. And so it was pretty easy here when you took out the previous month's high to say, well, gosh, we could certainly run higher into these big timing counts. And so on a monthly basis, you would think it's really unlikely that the high is in Minneapolis wheat, but it could be. It made it to the first 618, so it's 760 in here. We wanted to go live with triggers. We talked to Roger about selling some 2018 wheat, which he did. I think it's 650, something like that. And he sold some $9 calls in here for 60 cents. So, there's ways to take advantage of that, and it doesn't mean that the high is here. This is the monthly chart. The monthly chart would argue that the high, while it might be in a Minneapolis wheat, we could easily make a higher low in October of 17 and have it run all the way to August of 18. So you're going to be hearing this a lot from me this trip, for you guys that drove all the way from Nebraska. If we can make lows here in 17 and then start making higher monthly lows, take out the previous month's high, take out the previous month's high. Next summer could be just darned exciting. But we don't want to respond to that and get bullish, because you're going to hear about how there's 9 billion people in the world, and there's not. There's only about 8 right now. You're going to hear about how the Fed's printing money. You're going to hear about all these things that are bullish about commodities. And one of the things we're going to talk about tomorrow, commodities are the most undervalued asset in the whole world. If you were a smart Wall Street banker, you'd sell your Google stock, and you'd go buy physical cash corn in some silly warehouse in Nebraska. That's how undervalued corn is, and pay the storage. And that's how overvalued Google is. But anyway, so this is the time count in Minneapolis wheat. We talk about the range. The market comes back to 0.25 of the range. You couldn't have calculated this until you had this high in here, but since that time, we've been talking about the 0.25, and it should trade 0.25, and it got there in 15, and it didn't go anywhere in 16, but it also didn't go down, built a great big base, and then all of a sudden in 17, something happens in the weather, and I don't know if they actually I don't know if they're really going to have a bad crop in Minneapolis wheat. Does anybody know? It was way too dry for too long, and then it rained. I don't know what that means in Minneapolis wheat. Does that mean does it recover like beans do? I don't know, but it did scare the market. Look, a huge ownership in Minneapolis wheat. And as we look at all these other charts tomorrow, you're going to see that there's no participation in corn. Open interest is very lackluster. Same thing in beans. Same thing in meals. But Minneapolis wheat, record ownership. Sugar, bizarrely large ownership position in sugar. And a number of commodities. So I would argue that the big money, because commodities are so cheap, is rolling into any commodity where there might be a story. And so if we can come in here next spring, and I don't know, have it freeze late in Minneapolis, or have it freeze late in North Dakota, or have it be too wet to plant next spring in North Dakota, this could easily have a higher low in October and even run all the way back to $11 next summer. At which time you're going to find me get extremely scared of the future and just be encouraging people to cash out and be happy. When we take this same analysis and bring it, so people say, what do these lines mean? So, man, this is so much simpler than some people want to think. So I just put the starting line at the low in 2002 in Minneapolis wheat. I put the ending line at the high. That wasn't very hard. And then I just let the time propagate itself. On Trade Navigator, there's a button you can push. It's called a Fibonacci expansion. And then you can put any number in here you want. I always use the quarters, and then the Fibonacci is a 618. And you can see that it, this is 144 months, or 72 months to the top, and then 144 months to this low. And you can say, well, the market didn't go up. No, it did recover, and then went on and made a new low. So we would expect to wait for the next timing point for the low. And in terms of a time value of money, the actual low in 2015 was that exact day, within a couple of trading days. Traded all the way sideways for an entire period of time, and then broke out afterwards. So Minneapolis wheat's one of the few commodities in the world that's in a bull market. Corn isn't. Beans aren't. What else is? Copper, I guess, is about. There's just like nothing. So again, that's why we have this huge position. Commemorative traders, yeah, the funds own a lot, but in Minneapolis they could buy a lot more if they wanted to. But notice that same time count that gave us these swings over in here that were pretty darn valuable for farm marketers. Huge February of 2020 turn. And that's using, so it's hard to appreciate the fact that's using a different day here and a different day there and a different number sequence, and it still comes out the same way in a commodity that's completely unrelated to soybeans. So anyway, it is definitely completely unrelated to copper. So I suspect something goes on out here that's important. And I certainly hope that we get this run back in August of 18 into some area up in here so that everybody can get prepared for what could be pretty ugly. We take that same technique of just marking a low, marking a high, and then doing the propagation, and then then it becomes art. And then bring that just to the monthly chart and blow it up so you can see it, right? Because I don't know about you guys, it's hard to see that chart. So that's just that chart. But you just look at a few less years, you can see the time count here comes out in August. We go basically sideways. You know, what does that mean? That means that we make new contract lows every single contract in here, and we sell off going into deliveries. But then we have this higher low here at the 180, and then we have a spike. And now we're just waiting to see what happens in October, and then next August, and then February of 20. So it's just easier for you to see. You take the same thought process and bring it to a daily chart to aid with decision making. So this is the chart that I had on the website here. This was posted in this time frame right in here. And we thought that these counts would come out June 30th, which is this day right here, I think. This might be June 30th right here. Anyway, we thought the market, so if you look at this, these are multiples of 24. Again, which is obviously a multiple of 12. And so you just put the lines on here, but these blue lines start all the way back in 2015 at that low, but they're on a daily chart. So you come across, and you can see the 0.5 of that time period was extremely critical. April 3rd, 2017, nailed the low to the day. You come across to the next repetition, and this is what you see happening in the bull markets, where you have the time period come out, and it's basically the time period is a test of the old high. If you break out above it, the market's going to just run. So that's what we want to see happen in the Kansas City wheat at this next period. And I've got just other days on here, but from this low, I had these on the chart before any of this happened. From here to here is 36 days, that to June 30th. From the actual low to the high was going to be 60 days, and that was on the chart back when it was all the way back down here. I talked at the time about how we had a gap at day 45, which is obviously multiple of 60. So again, it's kind of become self-reinforcing. So you have all these time counts come out, June 30th, July 1st, and then of course the actual high is July 4th, because this is the holiday. You've got the weekend and the holiday messing all this up. And so the market actually opens, very high after the holiday on July 4th and then collapses. Since that time, it's kind of had a 3 to a 6 day rhythm going, and I don't even know how it closed today, but from here to here is it's exactly half of the time period from here to here, and we have this meltdown low right here on exactly the right day. So on the report day, I would have told you that we could either have a bullish or a bearish report, and if it's a bullish report, we definitely want to be selling wheat here on this day, and the market didn't give that to us. The market got bearish numbers and instead melted down into that day. Now, if you guys know, corn, wheat, and soybeans have just continued to melt down, and Minneapolis wheat has not. That's really bullish Minneapolis wheat. If you haven't sold your Minneapolis wheat, don't panic yet. Let's wait and see what happens, because the game's not over. We've got this retracement. I mean, if you're going to panic, at least wait until you take out the low of day 60 or day 90. But it's indeed possible that we can get this thing to rally back into October or make a higher low here, out here at the completion of the timing pattern in September. All the crops in the bin, nobody's going to sell it, and we'll see what happens. So I was trying to use this whole presentation about Minneapolis wheat to explain how we get the vertical lines on the chart. I can't believe, I've been giving speeches about this for almost closing in on 30 years now, and you just never see this anywhere. I can't believe nobody else publishes stuff like this. Quigley publishes planetary cycles. James Flanagan does a great job publishing historics. Very, very few people are doing this kind of harmonic stuff, which it blows me away. And part of it is you have to be willing to be wrong sometimes, and you have to be willing to admit that you don't know for sure what the future holds. So in this case, all I did was take that chart, make it bigger, so it's a little bit easier to see, and a little bit easier to see the stair step as it's come down. And I have put this 9/14 day on here as if you count from this low over here, make that the halfway point, then you come on over. That should be pretty important. So if the low's not in Minneapolis wheat, and we trade sideways or chop sideways for a month into September, it'd be certainly a good time to get positioned for a recovery rally. Because I do think that we do know that the Minneapolis wheat crop is hurt enough that there's going to be some concern about how many bushels there are this winter. So, Roger asked on the site, and and I encouraged him. He did sell some wheat. One of the last things we wanted to talk about was, why is it easier to sell next year's crop this year than this year's? Eddie asked a great question before. Why are we selling? Are you going to sell it in the front end? Are you going to sell it in the back end? And in this particular case, this is Minneapolis September 18 wheat. And I always like to look at these. If you look at this chart, if you sell it any one day, you're wrong by 30 cents, almost before you get off the phone when things are going like this. Or if you use a trigger, like if I would use my trigger to sell the previous day low, right, I would have sold at 775. The high that day was 850. That's not optimal performance for the way I like to think of the world. We would have been selling some calls, so we probably would have been okay, but to go with it. But the point there is that is becomes so emotional that it becomes very hard for human beings to keep their heads on their shoulders. And for me, if I go out and look at the next new crop, and look at this, the deferred crop. So there's the high. This is the next 10 days trading, right? The nearby contracts just get hammered. Then we have we have a really easy gap up day. Gap fails. That's all you got to know. Throw in the towel. But if you go look at the new crop, so the 2018 crop, and arguably even the guys in North Dakota will tell you if they have a bad crop this year, the odds of them having a better crop next year are higher. Just like in Indiana, if we have a really bad crop this year, the odds of having a good crop next year are pretty high, almost 3 out of 4. No guarantees. But if you look at this contract was making higher lows, while the nearby contract was making lower lows. This contract couldn't even make the gap higher. So when the gap was filled, look, I mean, to me, one reason I don't know, why am I not short 1 million bushels of September 18 Minneapolis wheat? It was so easy. You have the gap up on the nearby chart. It goes sideways the next day, fills the gap. But look at the deferred chart. The deferred chart fills that gap even before it gets halfway through the trading session. This was like the ultimate sell signal, Minneapolis wheat. And for the crop out there, you would be selling it at 670 or 665, and the high for the move is 685, right? It's a little bit easier mentally to sell 20 cents off the high than it is 80 cents off the high from this morning. And this is normally what happens in the deferred contracts. If it's going to be a good signal, the thing just fades away. You're taking almost no risk out here. You can let the market decline to your timing point, and then you can buy a call, a 670 call for 15 or 20 cents, and you've got a break even with unlimited upside and a floor at 650. And we've done that in the corn market for years now. You know, we had some extra corn this spring where, you know, we just set up a contract with the Andersons, and we sold calls in January, and we sold calls in March, and we sold calls in June. And we ended up making like 31 cents selling calls. So you can do this, especially in the out years, an awful lot easier. And this is why I try to tell people when things get really emotional, if you don't know what to do with this year's crop, because if you're going to have this year's crop, sell some of next year's crop, and then build into those positions. And as that one becomes right, I would argue that so he's got 25%, let's say, of the 18 wheat sold. Just forget it. Just say thank you, but don't sell more on weakness. Let's wait. Let's make this thing. Let's make this thing recover over here into either the winter or next summer before we sell more. At least let's wait and see if it recovers into September or October. And if it does, well then let's make that next sale at 680. So all of a sudden we've got half the crop sold within a dime of contract of highs. And I know most guys in North Dakota can grow wheat for $5 or so, all costs including labor. So 650 is not exactly a bad out. Even if it goes to 12, we can sell some more. Then we can go into the 19 crop. So this is one thing that I've used for teaching purposes in the past. And I think it's a little bit helpful to get out of the corn, soybean, wheat realm because everybody gets so excited because they all know about it. So let's just take a look at sugar. And again, for just definitional purposes, I know it's hard. Most people have been trained to only think about price, not time. So it's really hard to understand that all I did was put a line right there at the low. The way this computer counts, it has to be the date, the period before the low. And I put the other line here at the high. And I just replicated this thing to the side. The computer does it. And when you're doing that, you're going to think, well, gosh, halfway back down should be support. That should be the low in sugar. It traded at the 0.25, which is what Ken said it should always come back to. It did. It recovered, had a really fast rally for about 5 weeks, and then just kept sliding away. And the only thing to say about that is, well, the 0.5 point was very important, but the market was just overwhelmed with supply, like they all have been. And that happens when you have when you redefine the price ranges. But we don't give up on our technique. We come out here to the 0.618, and we say, gosh, if you look at this chart, all these dates were important. The half was important there. The half was important there. I mean, it recovered hugely for a few weeks. The 0.67 was important. It seems like this time repetition has some value, so we're definitely going to be watching at the 0.618. And if you go to sugar and you pull it up back in 2015, the time count from here to here in terms of trading days is off by 1. It's like 7,000 trade days, and it's off by 1. So this was that's the way you want it to work every time. That's the way you want it to work in Minneapolis wheat. You want it to just keep flying for a year and a half, and it certainly could, because even in this market, right, you go up for a few months and you back and fill, and then you keep going. In this market, you'd think the high would be at the 0.75. It's the next repetition. As a producer, it was awfully good time to sell sugar. Yeah, I know it went back to 24, but you were selling it at 20. It had just traded at 10. If you're not willing to sell it at 20 when it just traded at 10, then I'm not going to be able to help you. That's not the way I think about the world. This would be the same thing as selling 650 corn right now. I mean, the 20 would be 650 corn. This would be like selling $7 corn. So anyway, and you're going to say, well, gosh, this high didn't match up with this time. There's nothing about this that matches that. And I'm going to say, man, you're right. And that's the way it works sometimes. So what I did is I came in with a second pattern and said, well, let's go from this high to this low, because that's a very important sequence. And you'll notice this is exactly halfway in between. So we got these two waves of human emotion here. And then this just made the low at the 0.618 of the multi-decade range. What if this rally is 0.618 of this? And it is to 1.5 trading days. So this is part of the art of this. You can't use it to predict the future. But as a producer, and if you're Ken and you've sold a lot of grain at 20, if this happens up here and then you get the market fails, at least you can maybe help bring yourself to understand what happened. And then you can say, pretty simply, well, man, if this is a 618 high, it ought to decline until the end of the time count, which is here in the middle of 2017, which I said. And it stopped within like 3 trading days. Just bizarrely accurate. And so now we're sitting here. We have this big count in May of 18, all right? Because remember, sugar is a lot different than wheat and corn, right? Sugar's big move was in 11, not 08, and definitely not 12. It was really 2010. So, but as we look at this, we got this huge count come out in May of 2018, and with the chart pattern that we have, it's either going to be a low of substance, probably back at 10 cents again, or it's going to be high, and it's probably going to be back at 24 or 28 or 30. And so all we're really trying to use this for decision-making purposes is to say, when sugar last week backs and fills to within 10 or 20 points of this low a few months ago, which we just know that's going to be important, and if it's broken, it's still important, because that means it's going to slide all the way into 18. We can just confidently approach that and say, if we're hedging sugar, and we're back down here at 13, we just want to lift the hedges. We want to cover those long in the money puts. We want to cover any of the short calls. We may want to sell some puts to take some ownership if we actually use sugar. And then we want to start looking at it deeper. And we got this going on. So, from here to this low over here, right, we had the commercials flat sugar, which is obviously not their normal course of business. Look at the bizarre money flow from the middle of 15 until the middle of 16 in sugar. Speculators bought 250,000, 112,000 contracts. That gets into hundreds of millions of pounds of sugar, and drove this move. And the commercials sold it all. And so that's very interesting. Obviously, as a commercial hedger here in late 2016, that's why I was saying if we're at 20 cents and the commercials are this short, I want to be selling a lot of my 2018 sugar production. And if you're growing sugar beets, this is what I'm talking about. We have a lot of subscribers that grow sugar beets. And when we look at this, we want to be defensive as producers, no matter what causes it. And now, all I could just say is, wow. Sugar's come all the way back down here. The commercials the commercials sold 300-some thousand contracts of sugar to greedy speculators in New York City and Dubai. And now that sugar's gone from 24 cents back to 13 cents, the commercials have bought all of it back, plus 50,000 contracts that they actually want now. So sugar's declined back to a timing point, it's declined back to a support point in terms of price. And we have this massive ownership position by people who actually use sugar. And so all I'm really trying to get at is if we're using this and we're looking at this and if we look at the soybean market, if beans go 40 cents lower and hit that long anticipated 887 again, and the commercials are long 200,000 or 100,000 contracts of beans, which they easily be, we could get awfully excited about owning soybeans. So anyway, a little bit of a preamble for tomorrow's presentation. For the guys that have been coming for a lot of time, I'm going to just say it's deja vu all over again. All the big picture items are the same. Stocks are overvalued, commodities are undervalued, interest rates are too low, the debt's too high, but it's all 1 year more mature. And at some point, exponential mathematics breaks down. So we're going to talk more about that tomorrow. Have a few minutes for questions, I hope, probably 5 or 10. Thoughts? Did I do hopefully a reasonable job of going back to the beginning about how we do the timing and how we use it to make decisions and what it's kind of telling us right now in some of the markets, I hope? Questions about the farm, about life?
I don't know how far ahead the chart is gonna. At some point it's got 3 triangles, at some point it's got 2, at one point it's got 1. What are the 3 triangles?
So what we've done, because I enjoy this, because I'm just a geek, okay? But most people don't enjoy looking at this stuff. And so what I've tried to do is to very simply, Brian, make important days look important. Red triangles are always lows. Purple triangles are always highs. Diamonds are, I have no idea, but they're very important, okay? And so when we look at this chart right in here, I'm saying right now that this high in the Kansas City wheat was a high. If you look at last year's chart, there was, I think, 1 purple triangle there. I'm saying with the price action, there needs to be 2. But if we can stabilize in here and go sideways for a few months and turn around, I may change it and just make it a low and make those red. So all we're trying to say is that when we look at this, if you look at the 114-month count in Kansas City wheat, and it tops out at exactly the right number of months, then that's a bizarrely important moment in time. And it's one that fits our timing analysis and how we try to think about the world. And so as we come over in here, this high, for the guys that have been around with us since then, you know that we were extremely bearish wheat right in here. It was just a perfect alignment with this rhythm, and it was a high and it was a lower high. It's like a death signature. A lower high on a timing point's a death signature. I mean, things are so bullish, and you still can't get a price above the old price. It actually becomes extremely bearish. If you remember 2012, that rally, if you think about that rally in Kansas City wheat, what was the weather like in 2012 in Kansas? Well, if it's not raining in Indiana, Pennsylvania, Ohio, Kentucky, Minneapolis, Wisconsin, Illinois, it's probably raining in Kansas. Kansas yields in 2012 for Kansas City wheat weren't bad at all. They weren't great, but I mean, so it makes perfect sense that this market would top out. Wheat always leads. I talk about that. Wheat topped in 08, corn and beans topped in 11 and 12. So it's not at all unexpected that this July 16th low here becomes huge. That's why there are all the red diamonds there, the red triangles, I mean. And now it becomes critical support. We really shouldn't be able to take that low out until we get out into 2020. We should just go sideways, and maybe we set ourselves up for a big recovery rally. So the red triangles are always going to be lows, or what we think should be a low, right? Because it doesn't make any sense at all to have this 114-month count come out as a high, and then say, well, yeah, but the next quarter is going to be it's going to be a higher high. Well, gosh, I mean, you should have a collapse. And if you look at this green bar here, which is a 114-month count, the green bar, you should collapse to the next quarter of that, and we did within 7 weeks. And so going forward, whenever you have something like this be a high, it makes absolutely no sense to expect the next timing point, the 0.75, to be a high. You expect it to be a low. So if you've got a low over here, and we're going to have a high either here or in here, you would expect January 20 should be a low. May not be, right? I don't know the future, but as we get out in there, I think we know with confidence that early 2020 is going to be really important to the world, some reason. Yeah. The one up here, this is where it gets a little confusing because, see, this is a different time count that we talked about before. This is a 144-month time count. These are 114s. 114 is planetary, 144 is multiple of 12. And the 144 comes out. So I just put the triangle up here on which time count it goes to. See, if I put it down here, you're going to be confused and think it goes with this one, but it's an entirely separate line of reasoning that gets you the same moment in history. Where the red and purple are is not really relative. Yeah, so if you see a red triangle up here, it doesn't mean I think wheat's going to be $12. Yeah. And it's like, and the other thing is, obviously I try to make some sense out of it, but I'm throwing darts, I mean, just honest with you. So like where this 24 is right here, well, the 24 is just where the gap is. That's where we should have got this time. So I'm just saying, if we recover back here into 2018, we should at least get to 670. I mean, we ought to just blow right through 670, but we won't. There will be thousands and thousands and thousands of contracts that will be sold at 670 in Kansas City wheat. Tens of millions of bushels will be sold in there. So maybe that's all we get to. But the point is that this rhythm here could easily become a high, especially if we can pull the same chart pattern that we just did in Minneapolis wheat. The wheats lead, we certainly could. And by the way, the supply and demand in wheat's a lot better than last year. Why are we already trading last year's price? That doesn't seem fair at all to me. Same thing here with the diamonds, the triangles I mean. So the purple triangle, I've just got it here in August of 18 on this, this is Minneapolis wheat. You know, if we can have any kind of weather to help this year's weather next year, pretty easy to see it getting to 1092 sometime next August. And so that's all that's really trying to tell you. You know, we've added both the triangles and the dates because you can't read the date off the chart. And I wouldn't give up on Minneapolis wheat at all. Open interest is huge. Almost 100,000 contracts. That's an awful lot for the carryout. Yeah. I've only been, well, so why? I watch Chicago all the time. At some point you just get disgusted and you want to watch something positive. But secondly, I want to watch what's working. So sugar is working. It has been for a long time. We ask ourselves in a business, this is like a business management question, right? Why are we raising hogs? I don't know. All of our profit raising hogs has been in the hedge account for 15 years. Why do we even raise the stupid hogs? Well, we do it because the manure's so good. That's a crazy reason to raise hogs, right? Just to get the manure. But the manure is worth that much money. In 15 years, the manure's been worth $2 million to us. And anyone that's put up a quad finisher knows this. So that's really, I had never even looked at Minneapolis wheat. I always like to tell the story. We sold some $20 calls over here. I got to talk to the head of trading for RJO O'Brien because I wasn't from North Dakota. What was I selling a call I couldn't deliver on? I said, oh, they're for sale, aren't they? He didn't like it at all. But it was a great learning experience. I mean, really, just to learn how that works and how really scared they get and what a great indicator that is. If I get a call from RJO O'Brien, head of trading in Chicago, we better be selling 16 years of wheat. If the world is that screwed up about what's going on, right? And so that's one of the things that you can do that are kind of fun sometimes, you know. I just did the analysis because Roger asked me to, and if we go back and look at copper, anything else like that, the daily Minneapolis wheat, these timing bars work in everything forever. It's just how you use them, and then you usually get an attitude and end up losing equity. But and I like to look at sugar and coffee and cocoa and those things because we just don't know what they are, so we actually make better decisions. I think in the corn market, I've been doing this a long time now, just like you guys have, and when I look at the growing season, we're growing a record crop this year. How is that possible? Well, it's been cool. Yeah, I know. So then, if it's been cool, let's go to soybeans. Soybeans hate cold. We're growing a record bean crop? I mean, how many more things can go wrong with it and still grow a record crop? I mean, not to moan in our own, or cry in our own beer. So we're up to 5/10 of an inch for August now, after 9 in July. The yellowing beans you're seeing you drove in are not because they're ripe. They're dying. But we got a record crop coming. And I know it's my backyard, but I've driven across a lot of the Corn Belt, and there's water damage everywhere. You look at our drone pictures, we're out of nitrogen, the neighbors are out of nitrogen. It's denting, yeah. Would have it paid to put more on? Maybe. But now it's dry, so it's dying anyway on the hills. So anyway, it becomes really hard when you're dealing corn and beans to not get sucked into what things they're trading, and that's why I don't want to get really pessimistic the grains right now. I love the fact we're trading a record crop going into harvest. Get it in the price. Get it behind us. Yeah. Yeah, so that becomes a little bit of a, so which in the money puts to buy? We're going to spend a lot of time talking about on the phone. We're going to spend a lot of time talking on the phone with Brian and Jordan. And we're just going to talk about, okay, and then I call Cargill, because Cargill doesn't even know when the money puts are. I mean, sometimes I have to call Minneapolis to get approval to put them on, because it's so much money. But we just look at, okay, so where's the market? So like right now, in the corn market with it trading 360, you can go like to even a 380 and not have very much time value tied up. We want to avoid paying for time by buying it with equity. You can go to a $4 put and have just 5 or 6 cents or 4 or 5 cents of time. And so when we look at that, we want to go and really just look at the market. What are the parameters? What are we trying to accomplish? And work with them on where's the most juice, where is the most time volatility, and avoid that. And when things get more and more volatile, you have to buy deeper in the money options. So it's really counterintuitive and really difficult to explain to your young Cargill buyer who you're training the fourth one of in 12 years that yes, I want to buy a $7.20 December corn put that's 80 cents in the money. Do they even trade? They must. They're on the printout from the Board of Trade. And so it depends on the volatility, and we're just trying to avoid volatility and get a very high delta. Now on the other side, on August 10th, when you do something stupid like I did and buy November 960 calls, we just wanted to spend as little money as possible because we don't have a very high level of confidence. We're trying to play home run derby. And usually you strike out when you do that, and we're going to strike out. But we've left 20 cents on the table. I think those bean contracts are worth about $11.30 right now. So we're back to $11.10. I really thought we were going to have a 95 kind of response to the report. I mean, it's just hard to believe the industry just took this number hook, line, and sinker and believed it. And it's hard to believe the farmers did. The commercials haven't bought much in this collapse. The farmers have been selling them grain. So it's our own fault. But anyway, does that help answer that? We just did some feed hedges, and I called Brian, and I think this is really when you call Brian, he asked Jordan for the right answer, so I guess they're a team, right? And he always says, well, Jordan's got the better computer. as much as I'm paying, you get 2 good computers. I don't know. Gotta have some fun with those guys. But for some fee hedges, we just sold some 360 puts and bought some 360 December puts and bought some 340 and 345 September calls. And they're not very much in the money at all. But they only have, because they're so close to expiration, they only have 3 cents worth of time value. We did that because we don't have any confidence that the market's going to turn around today. If it does turn around today, then that 3 cents was a brilliant decision. If it doesn't, I only lost a nickel. And I'm quite fine selling the 360 puts, which means I'll be buying feed for my pigs at about 340. I'm really good with that. These futures might go to 320. I doubt it. They might go. They could easily go back to $4 in 4 weeks. I mean, it's sad that we have to hope for a frost on our northern friends, but cold, man. We need cold. Yeah. Yeah, for merchandising, yeah. Well, yeah. We may sell a call, or we might buy a put. It depends on where we're at, which bushels we're marketing, and when we're doing it. And we're trying to do a little better job updating that on the website. In some cases, we don't. And in some cases, we call them hedges if we're wrong. We call that making money. We're going to lose it on the call. But like I said, some of that corn, that extra corn we delivered in June, boy, we sold it 3 times and didn't have to. We were willing. So maybe the better answer is most times we won't sell those calls except on bushels we know we're going to have. And if they're exercised on, we're going to just take that price plus the premium and be happy. And then if we want to buy a call later or buy another put later or sell calls on another bushel later, we talked about that last winter. Last year in the corn market was all about merchandising. Every 20-cent rally, sell a call, 10 cents out of the money. And if they get you, which they got us once, deliver that corn, sell some more. Yes, yeah. And very seldom am I even going to do that in my futures account. Right? I'm going to do that on bushels I know I'm going to deliver, and I'll just take the price. Which like in 2007 or 2008, cost us some money on the way up because we'd sold some corn at $5.50. By delivery, it looked awfully good. There was about 4 weeks in there where it looked pretty stupid. Yeah, we have to. One last question. I'm sorry. Actually, it's kind of surprising that there really are very few that line up with the eclipse. There are a lot more that line up with the lunar eclipse next week, first week of September. You've heard me talk about the first week of September for a year. Remember the ellipse cycle? It's an ellipse cycle. The fact that the media covered one doesn't make it much more important, other than it split the country in half. But we have them every 6 months somewhere in the world. And there's always, it's the solar eclipse. I've done the statistics on this. There's a solar eclipse, which we now have on our charts. There's the lunar eclipse, which we'll have on our charts. When we break out of that range, that move should have some volatility. And so I am certainly hoping, like Eddie, that we have the high on the wheat charts, which is a nice little daily swing high. We put a low in on the lunar eclipse next week, and we break out of that range to the upside. That has some statistical validity as an indicator, about 67%, which is far better than half. But we can play with it. It's pretty easy to manage that way. So to wrap this up, because we have to get out of this room so we can set it up for dinner, we're going to all move to the tool shed, which is right over here. And if things are going according to plan, and we'll keep our fingers crossed, we're going to be having hors d'oeuvres. And we have beer and wine and Coke and soda and water. So grab a drink and some hors d'oeuvres. And then we're going to have some walking tours for anyone that wants to walk. And if you don't, you can just wait in the tool shed until we come back here at 6 o'clock. But we do have to be out of this room.